Hello and welcome to Climate Bonds Initiative's 2016 webinar series. Today we'll be exploring the win criteria of the Climate Bond Standard with Climate Bonds Anna Creed, Head of Standards, and Rob Fowler, Head of Certification. We also hope to be joined by Naveen Khandelwal, Head of Investments and Strategy from Hero Future Energies, who's going to talk about Hero's experience of certification using the win criteria. We're having a couple of technical issues with the connection with Naveen, but hopefully that's been cleared up. First, a couple of housekeeping notes. To keep up to date with all our work at Climate Bonds and for announcements of future webinars in this series, you can register for our blog at climatebonds.net. If you have any questions as we go through the presentation, please use the Q&A box in the bottom right-hand corner of your screen. I'll collate them and put them to our panelists at the end of the presentations. Finally, this webinar will be recorded and sent by email to all those who have registered. Now over to Anna.
Great, thanks, Johnny. Basically, this morning in this webinar, or this afternoon, depending on your location, we'll be covering a quick overview of what CBI does in the green bond market and how it's developing. We'll be talking about green bond labelling and the role of standards, and within that, talking more specifically about the Climate Bond Standard and Certification Scheme, and then going into further detail on the WIND criteria under the Climate Bond Standard. And then, as Johnny has just said, we're hoping to be joined by Naveen from Hero Future Energies. And lastly, we'll have the Q&A session with myself, Naveen, and my colleague Rob Fowler as well. So firstly, the Climate Bonds Initiative, what we do. We have four main areas of work. First of all, we have established and we run the Climate Bond Standard and Certification Scheme. This provides definitions for investors and guidelines for bond issuers. These definitions cover essentially what is green or what is climate friendly in the world of capital assets and projects. And these definitions are developed through multi-stakeholder engagement with our technical working groups of scientists and other technical experts, and our industry working groups of market players. And the benefit of the Climate Bond Standard and the scheme is it increases investor confidence through having stakeholder-driven, science-based criteria for what is green, and also providing robust and clear assurance and certification frameworks for the verification that those standards have been met. We also provide information flow to rating agencies and index providers. A key part of the market, the green bond market, and growing that market is going to be robust and extensive data. So that's something we do put a lot of time into. And the picture on this page shows the cover of the latest State of the Market report about climate-aligned bonds and green bonds, which is available on our website, which takes a snapshot over the past year. And that's in addition to our market blogs, which provide up-to-the-minute information of green bonds that are being issued. We also do a lot of work on outreach to inform and stimulate the market. This includes government advice and policy models, and we're putting a lot of effort in emerging markets to grow issuance, particularly but not exclusively in China, India, and Brazil. And we're getting good penetration in terms of alignment with domestic regulation and issues in these markets. And lastly, our Partners Programme provides a platform for market participants to get involved during the formative stages of the Green Bond Standard, and it's really tailored to support CBI's efforts to accelerate growth in green bond issuance and demand. For those who want to get deeper into this space, please do contact us about that. We'd be very happy to talk to you. And then, just very briefly, for those of you that are new to this field, I'm just going to do a very quick recap of what green bonds are. Essentially, a bond is simply a form of debt. The issuers are effectively the borrowers, and the investors are the lenders. They're usually issued by companies, governments, municipalities, or banks. You get a really large variety of entities issuing bonds, and interesting, they do sometimes buy each other's bonds. Because of the size of a bond in general, we're talking, I mean, it varies a lot, but you're talking up to billions of dollars. They're usually used to finance large, mature assets, and they become an important part of investment portfolios for investors such as pension funds, insurance companies, and institutional investors. They're often seen as a defensive investment. So it's commonly said that you go to the equity markets to make money and you go to the bond market to keep your money. So they generally offer lower returns, but they're more secure than equity investments as a very general rule. And a green bond within that is a bond where the proceeds are used to finance environmentally friendly assets. And this therefore has an impact on who wants to buy or the investor base that's investing in green bonds. And what we're obviously hoping at CBI is this will lead to very positive impacts in the world to help us move to a low carbon future development trajectory. And essentially the climate change challenge and opportunity is that we need 50 to 90 trillion to finance low carbon transition over the next 50 years. And that is a gap that we really believe that climate bonds and green bonds more broadly can have a very significant part in filling. The climate bonds has a climate focus, and within that we talk about mitigation and also adaptation and resilience. In the investment community though, we often talk about asset classes. And so you can see on this slide here the icons for some of those key asset classes. So we have renewable energy, which includes solar, wind, that we're going to talk about more today, bioenergy, geothermal, hydro and marine are some examples. We also have low carbon buildings and industrial facilities, low carbon transport, so road, rail, water transport as well, buses, electric vehicles, etc., etc. Sustainable water management is a key part of a low carbon future and a climate adaptable and resilient future. Next we have waste pollution and management. We obviously also have land use sectors and assets around agriculture, forestry, mining in some cases where there's land use aspects. And then other sectors include ICT and broadband as well. And this is essentially our view for 2050. To have solved climate change, we really need to see investments in all of these sectors switch around to being green, climate-compatible investments. And that's what we hope the standard will help to push forward with. And just then a very quick recap of the state of the green bonds market. You can see from this bar chart that we've had very steady growth from the start of this market actually started in about 2007, with the first green bonds being issued by development banks like the World Bank and the European Investment Bank. And that kind of trend with the development banks continued up until about 2012 and 2013, and they remain a key part of this market. Interestingly, in 2014 onwards, we start seeing a big jump up in corporate green bonds issued by corporates. And when we're looking at the year to date for 2016, we're already seeing a significant increase. We're up to, I think, about 46 billion at the moment. We have expectations of 100 billion of green bonds by the end of 2016, and a large chunk of that we expect to come from China. The People's Bank of China estimates 46 billion green bonds issued in China this year. And those green bonds cover a really wide range of green assets. So you can see on here that the largest chunk of the pie is for clean energy, and it's definitely the most developed segment, but it's also joined by a really significant chunk from low carbon buildings, and that's often energy efficiency in those buildings. Low carbon transport is key. Water is a really key segment issuing green bonds. Obviously they have very large, very long-term infrastructure projects, so they're very well tailored for the green bond market. And also there's smaller segments but growing all the time. So waste pollution and control, agriculture and forestry is a key segment we expect to expand, and other smaller sectors on the bottom there. And questions that we're often asked is, what is a green bond and what's the value of a green bond to an investor, especially when it costs to deliver a green bond? And here we've summarized some of the attractions of green bonds. So from a borrower's point of view or the issuer's point of view, really issuing a green bond can bring investor diversification across regions and types. And we have commonly seen strong oversubscription of green bonds, leading to tighter yields. Demand is definitely exceeding supply at the moment, which is a really positive message to green bond issuers. Also, it's interesting that it tends to bring in new investors that they've not been able to access before. So, hence the diversification of their investor base, which is another key attraction for issuers. And more generally, it strengthens their reputation. It gives strong messaging of the importance they attach to climate and green issues, and what they're actually doing in the world and in the market to invest and change in that. And similarly, on the lender side, for the investor benefits, I mean, it might be a truism to say, but often what's measured is actually managed. So when people are issuing in investing in green bonds, they know that people are really looking at the use of proceeds, looking at managing those use of proceeds, perhaps more than with other bond investments. And well-understood projects can reduce risk exposure, and well-managed projects similarly reduce risk exposure. And like with the issuer, investing in green bonds can strengthen a company's reputation and lead to a deeper engagement with company management on green issues. And we're increasingly seeing investors allocating a greater proportion of their funds for green investments. And this is really positive news to helping to grow this marketplace. Okay, on green bond labelling. Essentially, if issuers are claiming benefits from green aspects of the bond, they need to protect investors from greenwashing. This is really important. The market, as I said, started with development banks issuing green bonds. Those banks have strong internal processes, relatively strong resources. They have their own credibility when they label a bond as green. As green bonds become more common in the market and they're being issued by a more diverse range of players, particularly across the corporate sector with varying levels of expertise and resources, it's really important that there is some credibility when bonds are labelled green, that they are actually green and are going to deliver green or climate-friendly outcomes. And essentially, a standard system or a monitoring system is essentially what we might call a system of environmental due diligence. It reviews key environmental attributes, and it really complements existing financial due diligence. And I think the important point here is that it's very difficult for investors who are looking at investing in green bonds to do this kind of assessment themselves. They're financial players, to be honest, and not always scientifically up to date with the latest information. And it's a lot of time and investment of energy and resources to really, financial institution, be able to assess really what's credibly green and what's not and what impacts it's going to have. And it's costly for them to do this, to assess it themselves. And so having a system where the rules are clearly laid out, where there's external verification, is a really positive positive contribution for investors who are looking to get into green space to take this workload off their shoulders. And the principles for a good system of environmental due diligence, basically that it's scientifically robust, it is actually delivering green or climate-friendly outcomes, it's transparent, and it's consistent, so there is comparability across issuers and investments and green bonds. And there's three key dimensions to green bond labelling. One is reach, and that might depend on whether we're talking about voluntary or mandatory participation, and connected to that, whether we're talking about recommended guidelines or principles or fixed standards and requirements. And this is really a question around the sort of programmatic approach that's being adopted, and that will often vary country to country and market to market, depending on the regulatory environment and just general market uptake and preferences. The second key dimension is scope, and that really covers the process of management of the funds, the reporting requirements, and what counts as green. And as I said before, what's key is to identify green and climate-compatible assets. And so in this context, you will hear talk of green taxonomies or green definitions or green eligibility criteria. And then the third key dimension is the assurance process. And this is the kind of assessment and verification angle. And there are different types of assurance that's given. One is first-party assessment, and that is people like the development banks that they do their own self-assessment. Second is second-party assessment, and that is where an external body is brought in to review a company's policies and adherence to those policies and the nature of their green assets. But those policies and green frameworks are set by the issuing company themselves. There's a distinguishing factor there. And the third type here is third-party verification. So again, this is independent verification, but this time it's verification against an externally set green bond standard or other equivalent green bond framework. So just a quick recap again on the evolution in green bond labelling over time. And as I said, I think I said previously, basically the first green bonds were issued by development banks, and they were basically self-labelling and self-verifying, and they could do that credibly because of their expertise and recognised experience in that space. 2014, when we started seeing the corporates coming into the market, was a bit of a shift in approach. So we started to see independent verification and second opinions coming in, but there is still a problem with consistency in the second opinion approach, given that different issuers are defining green differently and including different sets of assets in what they call green. So consistency is the challenge with the second opinion approach. And then the climate bond standard started in 2011, but it was revamped in 2015 to be more rigorous and aligned with the framework of the green bond principles. So now it's fully aligned with those principles, but it takes it further to define a climate-compatible taxonomy of eligible investments and eligibility criteria, and a third-party verification scheme and assurance framework that bonds have to meet in order to be certified and acknowledged as a climate bond standard, climate or green bond. And I think most recently it's important to note in this evolution is we are seeing more countries developing their national green bond regulations. And a key example in this space is China, who is releasing their own domestic regulations at this time. Looking forward, we see strong investor demand for green bonds and climate bonds, and we really expect this would increase in line with the delivery of credible and quality products into the market. Standards, assurance and certification are things that investors have repeatedly identified and called for as being key to improve confidence and transparency and further strong growth in the debt market. Basically, these sort of things will make it much easier to mainstream investors and help them get on board with real confidence in the green bond market. There is, of course, a risk that if robust standards and independent verification are not used, then green bond labelling might lose its impact. And governments have a key role to play, actually, in developing and rolling out mandatory green bond regulations, as well as, importantly, encouraging market development for green bonds. And what we would really want to see, what we think is critical to success, will be harmonisation of cross-territory standards with national regulation. Again, this will help to really increase consistency and transparency and ultimately, therefore, help investors build confidence and help issuers to minimise their requirements when they're working across different territories, which will be really key in terms of minimising transaction costs. And moving on to the Climate Bond Standards and Certification Scheme in a little bit more detail. The Climate Bond Standard is a robust and effective certification scheme. It sets clear, objective, sector-specific climate eligibility criteria for projects and assets, and those are the criteria that are developed through the multi-stakeholder process. The certification scheme also includes clear mandatory requirements regarding the use of proceeds and tracking and reporting, and this includes an assurance framework with independent verifiers. And then lastly, the scheme includes certification by an independent climate bond standards board, and on this board we have investors and NGOs which have $36 trillion of assets under management coming from a whole range of different investor groups. As I mentioned previously, and it's probably important to reiterate, the green bond principles are fully integrated into the climate bond standard. So if you use the climate bond standard, you can be confident that you're also falling under the requirements of the green bond principles and you are satisfying those requirements. A wide variety of bond types are eligible for certification as well, so we really try and broaden it out so that regardless of the bond type, you can be certified and have this clear mark when you go to market. One thing that's important to remember, though, is that the climate bond standard is an environmental standard, not a financial standard. So investors must do their own credit analysis And in practice, as noted previously, the standard provides clear requirements for issuers and their bonds to be labelled as certified climate bonds. There's a certification process which aligns with the normal phases of the bond market. So there's a pre-issuance phase and a post-issuance phase. The pre-issuance phase enables a quick movement to market. We look at the assets, or the verifiers will look at the assets the bond will fund and check that these are in alignment with the climate bond standard. Then report on that to the issuers, and that report is shared with the Climate Bond Standard Board for review and certification as appropriate. And then the issuer can go to market with the Climate Bond Standard mark, so that it's clear in the market that the bond has been certified as being meeting the Climate Bond Standard requirements. And then post-issuance, there is a secondary requirement for reporting. Again, the need for independent verification is required, and really the requirement there is to ensure that the use of proceeds have actually been allocated as was expected in accordance with the green framework under the Climate Bond Standard. There's actually therefore two components to the standard itself: the parent standard, which includes the general requirements and the Climate Bond taxonomy, and those general requirements are around the monitoring and reporting and management of funds, and the sector-specific technical criteria, which is really where we define what green is. And in terms of those sector-specific criteria, this next slide just shows the Climate Bonds taxonomy, and it breaks it down a bit across the different sectors and then under those the different elements within them. So we have obviously here various energy, renewable energy sectors. We have elements relating to the low carbon buildings, industry and energy intensive commercial, waste and pollution control, and transport, etc., etc. I think one thing to note here is these ticks, which might be a little bit difficult to see on your screen, but the blue climate bond tick means we already have criteria for these sectors and these assets. The yellow circles mean that we are currently developing them, and they will be released shortly to expand the eligible assets that can be certified. And the other areas that currently have no circle are on our radar, and we will be moving to those as fast as we can. We're working hard to fill out this library of criteria, and it's really critical. The faster we can get this rolled out, the more assets can be certified under a climate bond standard, and we hope greater uptake in the market. The next slide, I think I've already covered a lot of this. So this actually just provides further information on the pre-issuance process and the post-issuance certification. And I guess probably just to reiterate here, both in the pre-issuance and the post-issuance certification, a verifier needs to be hired by the issuer, and they will undertake an assessment of the green bond and the use of proceeds, planned use of proceeds, and subsequently actual use of proceeds, and verify that is in accordance with the requirements of the Climate Bond Standard. And once the bond is certified pre-issuance, the issuer can use the Climate Bond mark in its marketing and documents and on its roadshow. And post-issuance certification, essentially once post-issuance certification has been completed and compliance has been verified, then the certification is valid for the term of the bond unless we detect a problem based on the annual reports that are made, in which case we'll probably go back for further info, but we have not had this situation yet. So every green bond that has been certified remains certified. And the next slide just visually shows a lot of the participants in the certification process. So we have a really fantastic range of issuers to date, including a range of really public and private entities across all of the different sectors that we have criteria for. And this group includes banks, financing groups, public entities, development banks, etc., etc. In terms of approved verifiers for the Climate Bond Standard, again, there's an ever-growing number and range of verifiers from around the world, and we're working hard to expand this group, particularly where there is regional specialization or sector specialization as well. So this is a strong and ever-growing group, which I think is important because it provides a strong peer group for assessment and verification. And just then, lastly on the left is the names and the icons of those 8 institutions that are on the Climate Standards Board that oversee and review the certification and approval process. Okay, and then now moving on to the wind criteria in some more detail. And just as a bit of context, the wind criteria were developed and released. They're one of our earliest sectors to release criteria into the market. And today we have 10 climate bonds certified, which are either exclusively wind assets or partially wind assets. The total value of those is 3.75 billion, although it must be said that some of those relate to non-wind assets, which are bundled up together in the same bonds. So we've had great success with the wind criteria, so fantastic to see. And then just quickly then, the actual technical criteria for wind projects and assets that are eligible for certification under the standard. This essentially, the text on this slide, this is how to identify projects and assets in the wind sector that are eligible for inclusion in a certified climate bond. We'll take this apart in the next few slides, but essentially in our 2050 vision, we see wind as an important part of the energy system and a really strong contributor to the renewable energy space. And we focus on production and delivery of wind energy and key components and transmission systems to enable that to happen. So just breaking it down into the key pieces. Actually, sorry, I'm just going to go back one slide just to read this bit out. So in its technical language, the criteria for wind are eligible projects and assets relating to wind energy generation will be projects or assets that operate or are under construction to operate in one or more of the following activities. So the first thing is the development and construction and operation of wind farms. The second is operational production or manufacturing facilities that are wholly dedicated to wind energy development. And the third is wholly dedicated transmission infrastructure for wind farms. And then breaking this down a little bit further, so by operate or under construction to operate, we essentially mean that wind assets can be either existing facilities or facilities under construction. And obviously bonds are often used to refinance assets, which is why we have existing facilities here, but not exclusively, so they may also be used to finance new assets and new facilities. And under development, construction and operation, we include and we incorporate project development pipelines, investment in the full project development cycle, and the total cost of delivered power, including operation of the facility. And this is intended to capture the full value of the assets that are being deployed. And in terms of production or manufacturing facilities wholly dedicated to wind energy development, this includes component manufacturing facilities, turbine, gearing, electricals manufacturing and assembly, mast manufacture, assembly and transport infrastructure, and blade design, manufacture, assembly, transport. And it's important to recognise that a whole lot of associated infrastructure is important to bring wind power into the system. And we look to include that by including for eligibility transmission infrastructure that is wholly dedicated to the wind facility. And that includes, therefore, connecting infrastructure to the main grid and equipment which enables the wind power to be transmitted. And now I'm just going to hand back to Johnny.
Thank you very much, Anna. Just a reminder that if you have any questions throughout this process, please use the Q&A box in the bottom right-hand corner, and I'll put those to Anna and Rob at the end. We're now hoping to bring in Naveen Khandelwal from Hero Future Energies. And Naveen, can you hear us?
Yeah, I can. Hi.
Great.
Good afternoon or good morning, everybody. Am I audible?
Yes, you're coming through loud and clear.
Okay, great. Yeah, so first of all, thanks Climate Bonds for giving this opportunity to share our experience of issuing country's first private sector, country means I'm talking about India, India's first private sector certified climate bond. Okay, so to start with the first thing is, of course, we did this issuance some time back, which was maybe around January 16. So before getting into the specifics of the bond and how was the process run and what kind of experience we had, and the issues and concerns and the or the process itself. So before we go there, some few minutes about who we are, what we do, and what made us think about going for this product, and then how market responded. So first about the group. So we are Hero Future Energies, which is a Hero Group company. Hero Group is a very well diversified big business conglomerate in India. They have a number of businesses, but the most important or the largest business is the automobile manufacturing. So the Hero Motor Corp, the flagship company of the group, is world's #1 two-wheeler manufacturer, and they're listed on Indian stock exchanges. Market cap is around $10 billion, and the company used to have a partnership with Honda for first 25 years of its existence, which is now no more there. But the group is still the highest market share group in the country and world's #1 two-wheeler manufacturer. Now, the Hero Future Energies, this company is a renewable energy IPP. We are around 3.5 years old setup, and so far we have been doing our business in India only, but very soon we will be having projects outside India also. We have been evaluating overseas market for quite some time, and in last 3.5 years we have done many wind projects and many solar projects. Many of them are operating, and rest of them are under construction or advanced stages of development. So we operate around 4 odd megawatts at the moment, while we plan to achieve 1 gigawatt, which is 1,000 megawatt operating capacity in next 9 to 12 months time frame, which is going to be a combination of wind and solar. But so this is about the group. But what I'm going to clarify a little later is the issuance which we had done in January. That was done from the intermediate holdco called Hero Wind Energies, which is the holding company for wind business of the company. There is another holding company parallel to it, which is Hero Solar, which is consolidating solar business of the company, and both these intermediate holding companies get consolidated in Hero Future Energies, the parent company. So what we are trying to say in this slide is, or at this point in time, is the first issuance was done by a very reputable, very recognized brand of the country, and which had its own sort of advantages as far as bond issuance go or bond subscription goes. Now coming to spending some few minutes on Indian renewable energy market size, and why we are sharing this is that market size is so large that we are going to grow many folds in next few years, which would have a lot of need for capital, because this business is capital intensive, and that capital is going to come from variety of sources, and one of them, maybe one of the important ones out of all sources, is going to be green bonds. And that's why we thought of doing first at the earliest, so that we get to engage with the community, the investor community. We get to see how the process works, so that we can keep on doing this multiple times as and when we need capital, and as and when the green market grows to the next level of its growth. So basically, next slide, slide number 3, is talking about the kind of potential country called India has in both wind as well as solar, and it's a very high potential. We have just exploited tip of the iceberg. Now coming to HFE itself, again specifics. So we are operating more than 10 projects spread across country, mainly the south and west part of the country, because that's where the resource is concentrated, especially the wind one. And as I shared earlier, we are a full-blown renewable energy IPP company. So we do development, construction, operations, maintenance, financing, and sale of electricity. Sometimes maybe even distribution and transmission of energy. Though we are not a licensee for sort of transmission or distribution services, but we can do that for our own energy generated. Now moving on to the next slide is some good things about our company. That the first and foremost is we are part of a very well recognized reputed brand, a corporate house. Apart from that, we are very consciously sort of designing or evolving our portfolio. So we do take care, or rather give a lot of focus to the asset quality and diversification aspect of it, because renewable energy generation is a lot dependent on the resource, and resource is variable or informed in nature. So one needs to manage the portfolio in a very calibrated way, and we do that by number of strategies, and one of them is diversification. Apart from that, of course, there is a strong team which has a lot of experience in the domain. Apart from that, we have been the debt capital market or the project finance market of the country is very active and deep, and we have been exploiting that to fund our growth, which we now intend to support or buttress with the green bond investors or green bond market. Okay, we can move on to the next slide, which is what is our near-term plan, or let's say medium-term plan, let me put it this way, because long-term plan is going to get determined by a number of other factors, which is one is how the policies evolve. Though for the last couple of years, Government of India is giving enough and more support and push to the renewable energy sector, and we have been one of the key beneficiaries of that, because we ourselves are growing at more than 100% CAGR for last 3 years, and we hope to do so for at least next couple of years, and that also a very high growth rate can be maintained. So in next 3 or 4 years, we want to go to 2 gigawatt plus operating portfolio stage. In terms of equity funding, we are enough funded from the family side of the business, as well as we are willing to partner with other equity capital providers. Those could be deep-pocketed, long hold period investment firms, which could be pension funds or sovereign wealth funds or infrastructure funds and all that. So all of them are going to contribute equity capital, and that capital is going to be raised from either banks or FIs. But now looking at the evolution of green bond market, we think a lot of it is, or a lot of it can be funded from the green bond sort of capital raises as well. Moving on to now the kind of opportunities which we have currently available, which can be evaluated immediately to fund as far as debt capital goes, are the 3 large opportunities we have shared as an example. We have a number of other projects also going on, either under construction or later stage development. But 3 things which we are trying to show here on slide number 7 is just to give an idea that now renewable energy has grown to a very large level. So earlier projects used to be of 20, 30, 40 megawatts. Now one can get large size project and as large as 200 megawatt each, roughly thereabout, which basically gives investors, large cap investors or deep pocketed investors, an opportunity to participate meaningfully and significantly in each and every of these projects. Earlier these used to be so small that some big ticket investors could not even think of participating, and they could not justify the process of investment and due diligence because the deployable quantum used to be very small. Now those days are gone, and especially India is able to offer very large size projects which can attract large size capital or large size checks, especially the debt capital. Moving on now into the specifics of what we have done, which was country's first certified climate bond. let me clarify or let me admit a couple of things that there were a couple of issuances which might have been done before us, but none of them was one by the private sector, second by the end user. Most of them were done by financial intermediaries for onward lending or onward investment. But and most importantly, none of them had gone for certification, which was a very big plus for us. And we got enough and more support from the climate bond team. And now coming to the specifics, so we did around $45 million US dollars issuance. This was a 5 to 6 years maturity bond. Of course, this was issued in India in Indian currency and was mainly subscribed by Indian investors. But I don't think that is the most important takeaway from this, because later on we saw a lot of global investors inquiring about the product and the process, and we saw a lot of traction around the issuance and how other people could have participated or are even now keen to participate. The issue was, of course, rated by one of the top 2 rating agencies in India, which is ICRA, which has an affiliation with Moody's, and the proceeds of the green bond issuance were used to fund the capex of the wind power projects which are under development or under construction. And the benefits which we got or we intended to get, some of them might take some time to come through, but clearly we could see all of those are realizable benefits. Are, of course, first and foremost is the assurance to the investors that they are investing in a project or in a company which is doing sustainable development things. In our case, sustainable energy generation, and by going for certification, and that too also from third-party verification agency called KPMG, investors were more than comfortable that they can rest assured as far as end user proceeds goes, as long as compliance with the required guidelines or norms is concerned, and the company's ability and willingness to consistently honor those commitments about end user proceeds, that these should never be going to fund any of the polluting ways of either generating electricity or developing infrastructure. That was so that's first and most important. Second one was, of course, because that had the first attribute, people were willing to give some very slight sort of discount on the pricing, but as I'm sure others must have shared, the pricing advantage was not significant. It was very minimal, and to be very it was very close to zero, because people want green as an attribute at the moment. Price discovery in primary market might be difficult because people always do opportunity cost of capital analysis. But what has been witnessed in the secondary market or the market which when the trading happens of the bond later on, people are going to put premium on the pricing or discount on the return expectation if the green bonds are certified and there is a third party verification and validation process in place. And third and equally important benefit which we got, or of course we might not have capitalized on the same immediately, but in the long run we are going to capitalize on the same significantly, is the access to the different set of capital investors. There are some investors who want to invest only in projects or companies who are doing sustainable development or sustainable ways of generating electricity. Those investors might not be comfortable or keen to invest in other companies or other financial products or other assets, but as long as we can give them certified and which is also verified by third party sort of financial product, they will be more than willing to invest, and they will be more than willing to give some premium also. So that was the third advantage which HFE got out of the certification. No, I think we are done with the presentation, but what in next 90 seconds I can share further is the process and how long did it take and did we face any issues. So let me admit one more thing upfront, that we started the process of certification quite late because we had planned this issuance a little earlier before we came to know about green bond certification process, how can we do it, how long does it take, how much does it cost, all those things we came to know a little later. But nonetheless, we decided as a team, as a company, to still do it because that would be our first step to go in this direction, which could benefit us in the long run, and that's why we did it. So we always got prompt support from the climate bonds team, and we could do the certification in, I think, 3 weeks flat. And but of course, marketing of our bond was parallelly happening. And when we got the certification, we told our investors, this is the extra thing or extra attribute which you are getting in your investment. You might not be willing to give us price benefit immediately here and now, but in the long run, this is going to be the case, and all of them agreed and accepted the fact. And cost of certification was also not significantly high. This was a really sort of manageable, or let's say we got approval for that amount from our board very easily, looking at the long-term benefits of it. Overall, this was received very well by the market. And last and equally important fact is we are going to do our second and third and go so on offerings very shortly, because we are seeing a lot of action and traction in the green bonds, not only globally but in the country called India as well. Thank you.
Thanks so much, Naveen. Great to hear from India's first climate certified bond. Just a reminder that you can ask a question by using the Q&A box in the bottom right-hand corner. I'll put them to the panelists now. We've already had a couple. We're joined at this point by Rob Fowler, who's head of certification at Climate Bonds Initiative. Let's start with, do you envisage there being a market standards rating for green bonds in the near term, as investors seem to be demanding ever-increasing levels of transparency? One for you, Rob.
Yeah, thanks, Johnny. Can you hear me okay?
Yeah, you're coming through loud and clear.
Excellent. So the rating of green bonds is a really interesting question, and I suppose what you've heard in the last 45, 50 minutes is about a climate bond standard that is a bit binary. It's certified or it's not as a climate bond. The ratings approach is more granular in terms of saying, how green is it? Is it super green? Is it a little bit green? Is it green enough? And is it green enough is really the challenge that a lot of the mainstream investors face. We're starting to see the ratings agencies come out with green bond products and add-ons to their normal ratings products. So we expect to see that continue. And I suppose, as we've seen with credit ratings, there's a wide variety of different approaches that each of the companies use. You know, Moody's, S&P, Fitch, they use slightly different approaches to do their ratings. So I expect there'll be a few different types of green bond assessments from ratings agencies. But what we're really focused on is trying to create a simple label that the mainstream investors can see and recognise and understand that means a few things, that there's a standard, that there's assurance, and that there's certification from their peers. That's really our objective here.
Great. Another question here, one for Naveen. What term were the green bonds for the Hero Future Energy issuance?
So,
hello, Naveen, can you hear us? Naveen? Apologies, we seem to have lost Naveen. Rob, can you answer that question?
I can in a few minutes, certainly. Do we have any other questions that we can respond to while I'm finding that?
One for Anna. Will these criteria and other sector criteria that you're developing under the taxonomy be developed over time?
Yeah, it's basically an ongoing rollout program. So we already have the criteria for solar, wind, geothermal, and various aspects of low-carbon buildings and low-carbon transport. They're already out and released in the market. We're currently working on, with our stakeholder groups, criteria around water assets, around land use assets, for example, agriculture and forestry, various marine assets, which include fisheries and aquaculture, marine energy such as tidal and wave, and we're also doing work around hydropower assets at the moment and bioenergy. And then later this year, we want to roll out programs of work relating to waste management and industrial energy efficiency. So it's quite a large and ongoing program, so it's definitely a watch this space. And those that are already in progress will be released for public consultation probably this autumn and released probably early in the new year once they're finalised, and the others will follow on subsequently after that. So yeah, please keep in touch with us about that.
Great. Another question here. As demand is currently outstripping issuance and the market looks for long-term, potentially buy and hold investments, conservative investors may have liquidity concerns. How are these currently being addressed? Rob, is that one for you? Hello, Rob, can you hear me?
Thanks, Tony. Can you hear me okay?
Yeah. Did you get that question?
Yeah, so there is definitely a tightening in the secondary market. We see a lot of the green bond investors are a sort of buy and hold, as the question suggests. There's a lot of stickiness, I suppose, to use a word that we see with the investors. I think supply and liquidity is our biggest challenge, but we're also seeing a good number of investment grade and those sorts of profiles of issuers, which will help with liquidity across the different ranges. There is definitely a shortage of supply right now, but we hope to see a harmonisation approach with China to help alleviate that a little bit, and an ongoing sort of programmatic approach from some of the issuers that have come to market already to keep sort of stoking the fire, I suppose. One of the key risks we face is that there isn't enough supply and there are liquidity challenges. We've seen investors dedicate a certain proportion of their assets under management to this type of investment. If they can't get that amount, then it's unlikely they'll increase their allocation. So it's something we need to definitely drive for in the months and years to come.
Thanks, Rob. Any other questions? There's one here. What are the general transaction costs in terms of when an issuer wants to issue a certified green bond? Is that one for you, Anna? Would you like to take that one?
Yeah, happy to start this one. Basically, there are two elements, or possibly three elements to the cost. The first one is hiring the verifiers for the pre- and post-issuance certification, and the cost of that will depend on the rates that those verifiers charge, and that will really depend on their own business circumstances, and also the cost will depend quite a lot in that respect on the nature of the assets being certified and the complexity of the use of proceeds, and therefore the complexity of the verification itself. Often, particularly with the renewable energy is a good example, these are relatively straightforward, and we see a range of costs from about, I mean, these are really rough numbers, but from a range of costs from, say, $10,000 to $25,000. In addition to that sort of cost element one, in addition there is a small fee from the Climate Bonds Initiative for certification, and that's 1/10 per basis point. So it's relatively low fees, so that works out as $1,000 on a $100 million bond, so they're small fees, that element. And then the third element to the cost is not so much a cash cost or a transaction cost, but I think the internal learning process that needs to go on within the bond issuer is something that does take internal time and resources. And obviously that will be larger on the first certified issuance, but that will obviously come down over time as the familiarity increases. And often that is linking up between the Treasury Department and other departments within the issuer and just improving the communication and the knowledge around green bonds and green use of proceeds. So that's an important third area, which is not a cash cost, but will definitely come down over time. I don't know, Rob, if you would like to add to that one.
Yeah, that's a really great summary. The decline in costs over time is really important. As we see programmatic issuers come to market again and again, they're sort of blending the verification tasks as well, so that they're doing a pre-issuance for one, and then next time they're doing the post for the first one and the pre for the next one, and they're just sort of getting efficiencies in that way. So yeah, it's encouraging to see that initial costs are still less than 1 basis point from what we can see from the issuers we've spoken to, and I think a lot of issuers are getting more than 1 BP out of the arrangements in the market. But so it's fairly digestible, if that makes sense.
Thanks, Rob. That's all we've got time for today. A big thank you to our guest, Naveen Kandawal from Hero Future Energies. Just a reminder that this session was recorded. I'll send links out to all those who have registered in the next couple of days. To keep up to date with all things climate bonds, including future webinars and our market analysis, you can sign up to our blog on the website climatebonds.net. Thanks for tuning in and have a good day.